slide webinars
Mm-hmm.
that are only like 8 to 10 minute lessons that I've always had kind of in the background whenever somebody asks a question that pertains to it, and so that's what today's deal is going to be. We're going to do a lot of stuff, and I've got a couple of income method number 9 things
Okay.
loaded up, so that's marvelous. Folks, if you've been to our radioactive trading webinars before, you know that what we're about is limiting risk, starting out with a limited risk position, and then by way of now 11 different adjustments, being able to take out even more risk or take income or both. And that's what we're going to share today, but we're going to share it from a whole bunch of different angles. If you haven't been coming for a long time, you probably haven't seen some of these shorts. So just before I do the first short, which is called Spread Trades After the Fact, okay, I'd like to do a poll and just kind of find out where folks are right now in their options trading journey. Like many of us, Mike and I both got started trading covered calls, didn't we, Mike?
Sorry. Yes, that's all I was allowed to trade when I first applied to trade options was covered calls, and that's how I learned under Ernie to start with. But I had a better experience with them than you did. I still lost money, but I had a better experience than what unfortunately happened to you when you first started trading those positions.
Right. I got cocky. I started trading covered calls back in the late 90s, and I had been to a weekend seminar where they taught how to do that. And of course, after 2 days of watching a computer or watching an overhead presentation, I was a total expert. Or not. But I made money a few times in a row, and I got pretty cocky about it. And anyway, I ended up losing almost my entire life savings in one play, doing the cover call trade play using margin. And so I got hurt real bad. Mike, we've got some really good participation out here, and I'm going to go ahead and close it down. We've got about 7 in 10 of the folks in the room have voted, and I know that some folks are listening in rather than sitting at your computer, okay? So I know that some of you can't vote. So let me go ahead and close this. Oh, okay, we got a couple more votes in the last minute. And that made it a tie. At one moment, the spread traders were greater in number than the covered call players, but right now it's a dead heat. It's just even. So we've got 56% of you doing covered calls or their cousin naked puts, and 56% of you doing spread trades.
Mm-hmm.
A second place, so that's tied for first place. Second place is long calls and puts, and but Mike, there are 15% of our audience that aren't trading options at all, and so I'm glad that I'm catching you now and saving you from Mike's and my dreary experiences. Mike, you say that your experience wasn't as bad, but what did happen? What did you find with having just a one-trick pony, just knowing how to trade cover calls, and that was it?
Well, it was a very common issue, I think, that I came across. And so when I started trading covered calls, I had some success for the first 4 months or so, meaning I was right about 70 to 80% of the time. I was earning, 3% when I was right and trying to keep my risks down. But then in the 5th month, I just hit a bad market patch, which comes up, every 5-6 months, for example. And I ended up with a 50-50 win-loss ratio on the 8 or 9 trades I had open. Now, but what I noticed is that if I looked at my account at the end of that 5th month, if I liquidated everything, just sold all my stocks and closed all my calls at that point, I was down about 8%, 9%. So I've been working for 5 months to be behind 8%. Now,
Not cool.
Yeah, a lot of the gurus you and I take a slight umbrage with, Kurt, because they all say, oh, it doesn't matter if your stock's down 20 or 25%. You're still able to sell calls against it and generate 3% per month. No, I'm in this business to grow my accounts. And if I've got a 30 or 35% loss and I'm only able to generate 2.5 or 3% per month, we're talking about a 10 to 12-month cycle just to get back to break even if the stock doesn't recover. Kurt, you and I have seen way too many people who end up in what's called being in winter, where their stock drops too much that they can't even sell a reasonable call against it.
And if they did, they'd lock themselves into a loss.
They risk locking themselves into that 40 or 50%, 30 or 40% loss, for example. So, you know, I'd had that same cycle happen again in the next 5 or 6 months or so. So after about 14 months, 15 months or so, I branched out of covered calls, started trading other strategies. Now, thankfully, I did get into collars, and of course, a lot of my customers at the time, when I told them I was trading the standard collar position, they said, well, you're wasting so much money buying the put. You know, still looking for a 2 or 3% gain on the upside. You're wasting so much money buying the put to risk 6 or 7%. You'll be better off just trading covered calls. Well, I still trade standard collars with a good portion of my account, and that's performed much better over time than the covered calls did, thankfully. But the married put techniques that we're going to show today, I've been trading those for the past 4.5 years, and that's greatly outperformed any option strategy I've traded over the last 10 years, including iron condors, calendar spreads, long options, long strangles, for example, things of that nature. So I've just been better with that.
Mike, I'm going to call attention to the poll because it's been up there for 2 minutes. And folks, I'd like for you to just choose one of these options. How happy are you with your 12-month performance doing those things that we talked about on the last poll? And today's class is not going to be all about polls, okay? But we just want to know who we're speaking with so that we can know how much we need to explain and how much you've already got and so forth. Plus, some of these questions are going to be, or what should I call it? The Socratic method of teaching. Right? So sometimes I'm going to ask you a question, and it's meant to teach a principle. Okay. So let me go ahead and close that poll in 3, 2, 1, and share it. Mike, we've got 9% that say that they're absolutely kicking butt and taking names, so that's great. Yeah. A greater number, 33%, say, well, you know, I'm making money, but not enough. And then 48%, and I thought that the largest amount would be here, 48% say mixed emotions. That means that maybe the losses have cut into the wins, maybe even, you know, turn them upside down. 9% don't just say I lost, they say, ouch, I lost, and 2% are ready to quit. Well, I'm encouraged to see that only 2% are saying that, but even for the 2%, I think that what we're going to give you today is going to give you some hope, okay? So very cool. All right, Mike, without further ado, I'm going to dive into the first of a series of webinar shorts. And so let's start off right now with what's the problem when we trade stock in the first place. You know, looking at this stock chart, okay, it's all over the board. And in fact, I actually traded this particular stock during this particular time frame. But what's really interesting about it, Mike, is that at no time was I able to lose more than 5% of my investment.
Okay.
No, at no point could I lose more than 5% of what I had sunk into this trade, because it was a married put together with a very special look towards money management, okay? And that 5%, even that 5% that I could lose in the trade was only 1% of my total capital. Okay, the dollar amount that I could lose was only 1% of the total capital that I had to trade. And again, that's because of setting it up a certain way. Now, Mike, can you see a lot of opportunities to make money in this chart?
Just about as much opportunity to lose money on that chart.
That's right. And there's also opportunities to make and then lose money, right?
Absolutely.
I mean, you could actually see your stock go up, or if you're shorting, see it go down, and then think, okay, great, I'm going to hold for a little bit longer, and then see your win turn into a loss. Well, what's really cool about this, Mike, was with this particular stock that I'm showing, XL Maritime Carriers, very volatile. At no point could I lose more than 5%, but you know what? After 3 weeks, I couldn't lose anything. I made an adjustment that we call an income method. I did an income method adjustment that took a credit and also made it so that I couldn't lose, and also still left the upside open, and I ended up making 10.22%. So that's kind of cool. You lose nickels, right? If all you can lose is 5%, and you make dimes, guess what? You could actually be wrong more often than right and still make money.
Right.
The problem with trading normally, though, is that we don't know what's going to happen next, okay? And if you could know, there wouldn't be a market. But what I'm going to do is show bulletproofing. Okay, we're going to just show one of 11 different ways to take income or reduce risk or both in a stock and option position. Okay. Now, again, this is we're doing dated examples. This is actually out on YouTube, Mike. When I got into this trade, I got into it live and I recorded it. I did a recording exactly afterwards, and so that view has had, I'm sorry, that video has had tens of thousands of views. And if you like afterwards, go ahead and check it out. But here's what I did: I picked up Research in Motion, guys that make the BlackBerry, and I did not do this. I did not sell a covered call. Okay, but this is the covered call that was available that day. This is what I just wanted to show. Now, Mike, when it's September, and in October, the same year, October, $85 call, slightly out of the money call, is selling for that much, for $6.10. What does that tell you?
Excuse me. Well, that tells me that something is really quick on the horizon. What I mean by really quick is that something coming up is going to cause the stock to potentially fluctuate wildly in one direction or the other. Now, we know this was an earnings event, but it could have been anything from a judgment on a patent lawsuit if we were looking at a stock that or a type of stock that you are familiar with, unfortunately, a biotech stock that has an FDA approval coming up in the next 2 to 3 weeks. That's what we'd be looking at here.
Right. Okay. So this is what was available to do, and if I had bought Research in Motion and sold a covered call, that would make my cost basis $77.94, and if I get called out at $85, I'd make a profit of $7.06, and that's good. I mean, what would that be? That would be like a little less than 10%. Okay. All right. So here's what, in fact, I did. I bought Research in Motion at 84.04, but I also went out in time and bought a $100 put option. Now, Mike, I'm going to tell you two things. Number one, I have no intention of holding this radioactive profit machine all the way until January 09. Okay, it's 07, and I don't have any intention of holding it for 15 months. I'm just using a certain principle that says that when you buy time value, you get better value for your money when you buy a lot of it at once. Okay, it's just like if you're buying an insurance policy. If you go month by month, you're going to pay more than if you choose option B and pay for 6 months or 12 months at a time. Okay, so here's the deal. I'm buying 15 months of protection here. I don't really have the intent to hold it for 15 months, but here's my total investment. Now, on the previous page, the total investment had been $77 change, right? Okay.
Right, so this looks like we're going the wrong direction.
That's how it looks, but, in truth, for the next 15 months, no matter what happens to the stock, I'm guaranteed to be able to get out of it for $100 even, right?
Yes.
I mean, I have to. I have to. And because there's 15 months of time, if I sell the stock and the put separately, I'm almost certainly going to be able to cash it in for more, right? Folks that understand about time value know that, even if the stock went down to, say $50 a share, well, the put's going to become worth $50 plus a little more because of time value. But the point is, the most that I have at risk here is $8.74 out of the $108.74, or about 8% even. Now, again, I'm going to argue that that's actually more like 5-6% because of the great length of time that's in here. Okay? All right, but here's the deal. Mike, I'm going to show income method number 3, which I call the bulletproof vest. Income method number 3 is a spread trade that's done after the fact. In other words, rather than anticipating what a stock may do and putting on a spread trade, what I'm doing is I'm responding to what the market has already done. Okay? So 3 weeks into the position, Research in Motion goes up enough that the January 09 $100 put option has come down to $19.80. Do you remember what it was on the previous page, how much it cost on the previous page?
It was $24.80, $24.74 or something like that?
It was $24.70,
$24.70.
which means the put has lost $4.90 in value. Now, a lot of folks will say, well, that's exactly my objection. I don't
Mm-hmm.
want to spend money on a put option. Okay? Well, I don't want to spend money on dental insurance. I don't want to spend money on car insurance. I don't want to spend money on homeowners insurance, but I got it. Okay? But here's something that's really cool. I sold to close the January 09 $100 put option, and simultaneously, this took me one commission because my broker treats it as a spread trade, which it is. The thing is, I just already own this put, right? I'm buying an October 07 $100 put option for $720. Now, Mike, is this going to result in a net debit or net credit?
Well, this transaction here is going to result in a credit. We are going to receive $19.80 for closing our existing put, and we're going to have to pay out $720. So we're going to receive a credit of $12.60 against our initial cost basis.
All right. All right. Now, that's really cool, because what happens is this settles, you know, just the day of. Okay, I get $12.60 in my account. It took me one commission, and I still have my insurance policy in place. It's just a sooner expiration. Remember before I told you I had no intention of holding it as long, as far out as it is. My intent is to manipulate it. And what I've done here is take a credit now, $12.60. I still have the $100 coverage, right?
That's right.
Just not for as long. So
Yes, shorten the time frame. Mm-hmm.
Yeah, here's a new picture. I've spent $84.04 for research in motion. I've also spent for a put option. So the total investment had been $108.74, but doing the spread trade, doing the bulletproof vest, brought in $12.60. Again, that spread was a response to the stock moving. So now my new cost basis for the stock plus having a put option in place is $96.14. Well, what's really remarkable about that?
Well, we've lowered our cost basis down to this price of $96 and so, but you still are holding a 100 strike put. So that means you've got a guaranteed exit that is higher than your cost basis.
Yeah. If my guaranteed exit is higher than my net cost basis, then I'm bulletproof. It means that the worst thing that can happen is I'm going to make $386. That's the worst thing that could happen. The best thing that could happen is that the stock decides to go up further. And it did. Okay? So here's the deal. The earnings announcement was approaching, and I am bulletproof. And I sent an email out to my Fusion subscribers saying, I know the future. And that's really remarkable because what do I normally say, Mike?
Don't know the future, which is why we're trading radioactively to ensure that we can't lose those 10, 15, 20, 30% that prop up from time to time.
That's right. I don't know the future. That's why I buy the freaking put. It's important. And you know what? I'm glad that I was able to dig up this research in motion trade, because I'm going to show you another research in motion trade where the stock went down. It tanked. Okay, I still managed to make money because I had to put in place, but the stock tanked. Okay. Well, anyway, I sent an email to my Fusion subscribers saying I know the future, and I normally say, hey, I don't know the future. Okay, and that's why I trade radioactively. But I said I know the future because I knew that my future was I was going to be tickled pink. Either the stock was going to go down, and I'd say, all right, you know, with 3 weeks of holding, I've arranged for a 3.5% profit no matter what happens. I've only been in this trade for 3 weeks, and I'm going to make 3.5% even if the stock tanks. But that's possibility one. Possibility two is the stock goes up, and as the stock goes up, I make more. And that is what happened. The stock ended up going up. I sold out of my shares for a 6-week gain. You know, I ended up holding for longer because I could. And it was a 16.23% gain. Now, Mike, I want to point out something, okay? This 16.23% gain is not on the same investment as the covered call would have been. Remember, the covered call reduces the cost basis of the stock, right?
That's right. We take a credit in, so we lower our cost basis, which sounds attractive, doesn't it, Kurt? That sounds kind of sexy to do time over time again.
It does. It sounds sexy, but you know what? If I had sold a covered call, I'd feel like a chump because I would have only picked up about 9% on the 9% on the smaller investment, the investment of $77.94. I'd have made 9-10% on that. But in fact, I made 16.22% on the $108.74 investment. Does that make sense?
That's right.
Why. Here's why. It's because the married put leaves the upside open. When you sell a covered call, as our covered callers know, you're on the line with me now, and many of you said that you were disappointed. Okay, we had how many that said that they were absolutely kicking butt and taking names? We had
single-digit percents, 9%. That's right, Kurt.
Okay, and let's also go back and let's find out how many are doing covered calls. Well, 56. Well, there's a disconnect there. Mike, if I was reliably making 3 to 6% per month, like the gurus tell me I can, and never take a loss, 3 to 6% per month, never take a loss. That's what they sell you. Well, I don't know that I would be bragging about only 9%. There's only 9% that are saying, hey, they're doing well, and I don't think that they're necessarily all doing covered calls. Here's the point. We started with 8% at risk. That was the maximum risk that there could have been to this stock. And then we went to negative 3.5%, negative risk, which is bulletproof. And then I'm going into the earnings announcement and not losing a wink of sleep. How about that? Okay. So that's one of our webinar shorts. Hey, how about that? So I call it when spread trades after the fact. The spread trade after the fact, of course, is taking that put option and manipulating it. Okay. So Mike, let's maybe take a couple of questions, and while we're taking those questions, what I'm going to do is throw out this question to you, audience. We've got 83 of you here in the room. Thanks for coming. I'd like to ask if this free information made a difference to your trading account, and there's oodles more in the blueprint. The blueprint is my book, okay, and it's stacked and backed with bonuses and the guarantee. Would you want to hear the offer on it? Would you want for me to give you that offer here at the end of today's lessons? Okay. All right, so having said that, I'm going to now pick up a different one of these. There we go. A different situation on Research in Motion, to be sure. Okay, and Mike, did any questions come in that would benefit the whole group?
Not just yet. Erna had mentioned when we were talking about the covered calls approach that Erna had mentioned that's just sort of the rite of passage. Everyone has to experience that.
Right.
Corrado and I are just trying to set up a time when he can schedule one of those free power options or radioactive trading help sessions. Unfortunately, I'm actually booked up the rest of this afternoon, it looks like. Right. But I do have time tomorrow, but it looks like we're going to set a time for Tuesday at 3 p.m. Let's see here.
Mike, while you're looking those up, I wanted to call attention to the poll results. It was 93.7, and then at the last moment there it turned to 90.10. Hey, the 10% of you that said, I don't even want to hear the offer, here's the good news. I'll make it at the end. So you can stick around, get all the information that you want for free. I think that you'd be missing something if you didn't get the blueprint, or at least find out about it. But hey, the purpose of this time right here and now is to teach, not to sell. Okay? So we are going to give an offer, but it'll be at the end. And for the 90% of you that said, yeah, I'd want to hear the offer, well, guess what? We'll do that at the end, okay? All right.
Okay. Real quick, I just wanted to say Erna mentioned that no, she wasn't discussing about, or I'm sorry, Erna wasn't talking about covered calls. Erna was talking about blowing up your portfolio. In fact, I had another discussion online with a gentleman here who was one of the 2 or 3% that said they were ready to quit because they had just lost most of their account. They wiped out most of their account last year. With iron butterflies and iron condor positions. And, of course, the risk there is that we suffer one loss. That might wipe out 10 or 15 previous gains. So it's easy to do, especially with those butterflies. And those of you who have joined us before, you've heard me say that all the strategies I've traded and all the strategies we support on power options, there are a few strategies I'll never trade in my personal account, and two of those are the short straddles and the iron butterflies.
Right.
The reason why is that if I was, honestly, if you're a good enough trader where you can pick exactly where a stock's going to be trading in the next 15, 20 to 30 days to realize that maximum profit with that tight, tense profit and loss chart that comes with the butterfly or the short straddle, well, you don't need to call me for help. You're going to be much more successful than I am. So.
That's right. Yeah, those. The thing is that it really violates the maxim of trading. The maxim of trading, the truth that you can't get away from, is that you have to let your winners run and cut your losers short.
Mm-hmm.
And the unfortunate reality of most spread trades, particularly a condor, can you possibly let your winners run with a condor?
Well, no, it's designed to be a neutral position where the stock has to stagnate between two strike prices in order for you to, make the full profit. And if it gaps up one direction, if it runs one direction or runs the other, you're going to have that full loss on the position.
Right. Mike, I'm going to show Research in Motion a second time that I played. Actually, I've played Research in Motion probably dozens of times, but over the years. I won't touch it anymore. It's out of favor. But Research in Motion 2 years previously gave me a 16 plus % gain in 6 weeks.
Mm-hmm.
And then I got in and she took a dive. I got in, here, and then I sold here. And that looks like a loss, doesn't it?
Oh, yeah.
Okay. But here's the deal. By using combinations of the radioactive trading income methods, I was able to get out with a small profit. You had a similar experience with Office Max, didn't you, Mike, where in 2008 you had picked up Office Max. It went down by 75%, started to come back up a little bit. It was still down 60% or so, and you had a profit of, what was it, like 1.5 or
1.8%, 1.6, 1.8% or so. The stock I bought at I bought the stock around 20. I bought the 22.5 put. The stock dropped to $5 per share over the course of the next 4.5 months or so.
Good Lord.
But following the radioactive trading techniques, I closed that out with a 1.8% gain, even though the stock was still down about 70% from where I bought it.
Right.
I was long stock the entire time. I never sold out a stock and just let the put run, for example. Mm-hmm.
Right. So you were long stock the whole time. And now 1.8% gain doesn't sound like a lot to write home about, but you know what? If everybody else that you know has got their money in mutual funds, which we're down about 40% by that time. This is just a few years ago. This is November 2008. You're sitting pretty. Okay, that's a good way. So here's the details on Research in Motion. Okay, I got into Research in Motion at $87. And less than 3 months later, I sold 100 shares of Research in Motion for $60, and I made a profit.
Mm-hmm.
What? That doesn't sound right, does it? Okay, got in at 87, got out at 60, made a profit. Okay, talk to me, Frankenberg. How did that work? Okay, so here's the deal. Picked up the 100 shares of Research in Motion and simultaneously picked up a $110 put option several months out in time. Okay, so the total invested amount is $113.50, and when you subtract the 110, the difference is $3.50 that's at risk. So I didn't have a whole lot at risk to begin with.
Mm-hmm.
It's just over about 3%. Now, here's the deal. I did that. I got the very, very deep in the money protection there. Well, it's not very, very deep, but I got deep in the money protection because I wasn't sure what was going to happen next. I thought, there's something going on. There's a lot of premium being paid for options on both sides. If you're going to sell a covered call, you could pick up a lot of income. Mike, if I had sold a covered call, if I had bought the stock and sold the covered call against, would I be looking at a really happy picture here over the next several months?
Not really. No, because you would have been stuck with one of those unrealized gains. It's okay to take that 25-30% loss there because you're still generating premium. But look, you're just treading water. You're just trying to make back what you've lost. Your account is down. You're not making profit.
Right. Yeah, when you have an overnight 25-30% loss, you know, your little 3 to 5% that you picked up for the covered call doesn't really cut it, okay? So here's what happens. The very next day after I picked up my stock and put option, kabam. Or actually, I think it was maybe 2 days later. 2 days later, kabam. It's toast. Okay? All right, so we used income method number 9, which is actually, of the income methods, this is the only one that I didn't personally invent. This is something that I kind of thought of, and I thought, nah, that's a bad idea. Let's not do that. And then your boss, Ernie, started doing this and having success with it, and so did you, right? You had some success.
Right.
Okay, so I thought, you know what? We better make this a new income method, and it became income method number 9 in the blueprint. And so I sold to close that $110 put option, which was way up, okay? But I didn't want to not have a put, okay? I still wanted to have a put option in place, and so simultaneously bought a $90 put. Now this generates a credit, yes?
That's correct. Yes, we're looking at a credit here that's being generated.
Yep, we brought in a little bit of dollars, and Mike, this is kind of like it's kind of like dollar cost averaging. It's kind of like that, you know, when the price goes down and you make a little adjustment. Well, here's what I did. I did a dollar cost average where I bought some stock at a lower cost basis, but I used my premium that I collected from income method number 9 to do that. Does that make sense?
I agree. I'm with you.
All right, so my new cost basis per share is lower, okay? It had been 80 something, and now I've got some more. But then the stock went down some more. Oh gosh. Okay, went down some more. So I used income method number 9 again. Rolled down the put, simultaneously selling a high strike and buying a low strike put. Brings in a pile of cash, and I use that pile of cash to buy more shares at a low cost basis. Okay, lowering my cost basis on the stock again. You with me so far?
I think I'm still with you.
Okay. It went down even further. Dang it. It started to come back, and I should have used an income method here. In fact, you know what? Maybe I did. I'm not sure. We'll look. It's been a long time since I've looked at this lesson. Okay. Okay, yeah, I did income method number 9 plus income method number 1. Rolled down the put, you know.
Excuse me.
The same month. Lower strike, you know what, that should say 60, I think. Okay, sold the upper, bought the lower, okay, and got a credit. And then also sold the $60 call. Yeah, I'm sure that this is a typo. Sorry there, gang. This should say $60 put. Okay, so I sold the 65, bought the 60, made a credit, and then took another credit from selling a call. And so the total amount that I have picked up here is $625, and then I bought 10 more shares at a low cost basis. Okay, all right. So that lowers the cost basis of stock even further. And finally, the stock went up, and I got called out. Stock goes up, I get called out of my 100 shares, but don't forget, I also have some extra shares in my pocket, right, that I have been picking up along the way.
That's right. You were using the credit you earned from the income method to buy blocks of shares, which don't have an expiration date,
right?
But still take advantage of the upward movement on the stock.
Now, without revealing what they are, I also used income methods 3 and 5 during this time to pull in some extra dollars, and then I sold the 70 shares. And so those stocks, the shares that were assigned at $60, my put goes to 0. Well, here's the deal. I have a total return, again, not super impressive. It's 0.7%, okay? But the net movement of the stock was that it was down over 35%. That's down over 35%, and I make money, okay? That is using the income methods of the blueprint, okay? oh, I guess it's 19.5 after it started to come back up. All right, but the point is, while most folks are still licking their wounds, including covered call sellers, okay, by the way, can you afford to sell a covered call right here?
Not really.
You lock in a loss, don't you?
Uh-huh.
I mean, if you buy your stock and it crashes and you sell a covered call here, you'll get some premium. But what if the stock goes up? You're going to end up being locked in to that lower sell price. Okay, so that was another one.
Quick comment, Kurt. This came from Amir, and this is discussed in the blueprint. Excuse me, Amir wanted to know, well, if you're buying more shares, did you buy more puts at that time?
No. No, it was a simple put roll, and then those shares are incomplete. They're not round lots. They're not 100 shares. It's like 10 shares here, 25 shares there. No, I did not buy.
And this is oh, go ahead, Kurt. I'm sorry. Yeah,
I'm just saying I didn't buy more puts. Okay, go ahead.
And this is what's discussed in the blueprint, that every income method has the, well, what are the pros, what are the cons? Well, the pros are numerous. The cons are, well, you want to be careful of this. And with what Kurt just showed, I don't want to say it's a con, but that's one of the things you have to be aware of. You should, that particular income method or the application of using the credit you generated to maybe purchase more shares or purchase more options, you have to be confident. You have to be really good that the stock's going back up in price. I had a position recently, Kurt. We talked about TLM. And you just discussed a little bit about the income method number 9, how that saved you. We talked about the Office Max position. A year ago, 2 years ago, I was in a position that got in similar to the Office Max trade, where I bought stock at around 19 and bought a 21 or so strike put, and the stock proceeded to drop to $11 per share over the next month and a half. I had no strong sentiment that the stock would return, so I was just comfortable enough to close that position out and only take a 4% loss, 4.5% loss on the position.
Now, that was your biggest loss that year in RadioActive
That was my
trades.
biggest loss, was 4.5%. That's right.
That sets me up for the next poll because I just showed research in motion how my risk on the research in motion started out around 3.5%ish, right? The previous research in motion play I showed where it was 8%, but in truth it's more like 6-ish, because even if the stock took a real dive, I had 15 months of time value, So, but anyway, here's what I'm going to ask folks, okay? I'm going to say, if you used puts last year and kept your risk to 5 to 6% max, okay, and then you had 11 ways to pay for those puts, those are the income methods, would that make a change for a better? Just looking backwards over the last 12 months. And the answers are this: no change, or I think I might have done worse. I might still have lost, but I would have lost $1,000 less, or more than $1,000 less than I did lose. I lost overall last year, but I would have won if I'd have done that. I won last year, but it would have been even bigger wins, or I would have been one that said I'm very happy with my trade. Remember, there's only 9%. Was it 9% or 6% today?
9%.
9% that said I would have been one that said I'm very happy with my trading. Okay, so just think about it. First of all, if you're a covered caller, remember that with the Mary Put play, I was making more on the Mary Put plays than most people ever see in a covered call play. Right, 16% on research in motion in 6 weeks. Well, if I had sold a covered call, even with that huge premium, it would have only been 9%, and it would have been 9% on a smaller amount. Okay, let me go ahead and close this poll there, Mike, and share the results. Okay, 8% say no change, or I think I might have done worse. Okay, you're being honest. So what you're saying is that you have a way to keep your risk down to 5 to 6%. You didn't take a loss over 5 to 6% at all last year. Okay, so they may be using other methods to keep the risk down, maybe super diversified. Okay, 4% might still have lost, but would have lost $1,000 less than they did lose. Okay, so I just paid for your blueprint. The blueprint cost less than $1,000. 27% I lost overall last year, but would have won if I'd have done that. Oh, 46%, our lion's share, or well, not most, it's not more than 50%, but it's our biggest number here. 46% say, I won last year, but it would have been bigger wins. Yeah, because something that folks overlook is that when you lose less when you're wrong, you have more when you win. You know, and if you have more in a winning trade, it's a bigger winner. Makes sense, doesn't it? 19% would have been one that said, I'm very happy with my trading. Before it was just 9, so we more than doubled. Very cool. Okay, hey, Mike, I've got the income strategies for buy and holders, and this is a really cool lesson that we did here, and it talks about how to hedge, how to take your stock and hedge it. Now, this particular fellow, one of my clients, was holding shares of McDonald's, okay, and his cost basis was very, very low, okay. He had been holding it for a long time. He had got it at $22.15, and along the way he'd been receiving dividends, but he just didn't have a good accounting for me. He says, I remember it was $22.15, but I don't remember how much I've collected in dividends so far. So we'll just leave that out, okay?
Mm-hmm.
Here's the deal. He wanted to turbocharge his income. He wanted to take more income than his dividends, right? He also wanted to leave the upside open. Leave the upside open. You know, if he sells a covered call, he doesn't leave the upside open, right?
Oh, right, yeah.
Right. And he also wanted to make the position bulletproof. You know, and I said, well, Paul, that's a tall order, but I think I've got you. I think we might be able to do this. Okay? Now, the popular way of taking income is to sell a covered call. And, you know, this was March of 2010 that I put this presentation together. I was showing this to Paul. Here's the thing. If he's going to sell the 67.50 call option, he's going to pick up 45 cents in premium for a month. Okay?
Mm-hmm.
Now, the bad thing about that is that it puts a cap on the upside. Puts a cap on the upside. Now, all this potential loss, well, his potential loss actually starts way, way down here because of his low cost basis on the stock. But the point is, he's only picking up 45 cents. And when he picks up the 45 cents, he caps his upside. Not a good trade-off. We don't like that. Okay, so I said, okay, Paul, what about this? What about picking up a put option? And see, the thing is, because his stock is way, way high over his cost basis, rather than buying an in-the-money put, I said, let's just buy it in the money as regards your entry fee. Okay, so he got in for $22.15, right?
Right.
So this $50 put is very cheap. It was only 87 cents. Okay, and so you have unlimited upside when you do that, and we like that. But remember, he didn't want to pay anything.
Mm-hmm.
He didn't want to pay anything for protection. So back to the drawing board. How about we add a put option and sell a covered call? Hey, we're going to buy a put option and sell a covered call. Well, not so much. Because now, instead of a way to win, we've got 2 ways to lose.
I'm in one of those positions right now. It's okay. I'm happy with it because it's bulletproof. The worst I can do is make 3%. The best I can do is make 7%. And right now it's about a 5% closing price. But, yeah, I cap my gain a little bit by doing that, but it's okay.
Right. Well, fortunately, the way that you did that, though, I'm just guessing because I'm not sure which position you're talking about, but fortunately, you've probably got a put option that's further out in time than the short call. Am I right?
Of course. Yeah, of course. Yeah, that's the WNR trade in Fusion right now. Mm-hmm.
Right. So your Fusion subscribers, you know, they're going to look at that, and when this call gets to, does it expire tomorrow?
No, it's a February expiration curve.
Oh, okay. So anything can happen.
Mm-hmm.
But if it does expire, there's still potential for it to go back up.
Yes.
For the stock to continue up. Yeah. Okay. Well, that doesn't help Paul. Let's talk about what Paul wanted. Paul wanted to be able to protect his stock in case of a sudden downturn. He wanted to not have to pay for it, and he wanted to also take some income, and he also wanted to leave his upside open. Looky here. We're buying a put option, and along with the put option, okay, we're doing a bear call spread. Sell to open the 65s and buy to open the 67.50s. Now this generates $1.16 credit. First off, Mike, does the $1.16 credit offset the purchase price of the put?
Yeah, we're about 30 cents above the cost of the insurance, right?
Yeah, it offsets it, plus it adds some. Now, this $50 put is 6 months away. These June calls are 2 months away.
Mm-hmm.
Okay? So after these expire, could he do it again?
Of course, he could sell another riskless spread trade done in the context of the married put position and lower the cost basis further and leave the upside open.
Let's look at what this net position looks like on the risk and reward graph. Bam. There's something missing from this graph. I can't put my finger on it. What's the deal? There's something missing. What's missing?
There's no red. There's no break even. There's no loss on this position.
That's right. No loss. He happens to be bulletproof. It looks like long stock, doesn't it?
Mm-hmm.
There's a little hiccup here in the middle, and what that hiccup is all about is if he's called upon to deliver his stock at 65, right? Because part of that bear call spread was a short call at 65. The other part of that bear call spread is a long call at 67.50. Well, Mike, if he gets called out of his stock at 65, he's been paid to. First of all, he gets out at a profit.
Mm-hmm.
The stock was what, $22.15 when he bought it.
Exactly.
But he's also been paid to own a long call. And as the stock keeps going up, so do his profits. There's no capped upside here like there would be in a plain vanilla covered call trade.
Mm-hmm.
Okay, so and also, yes, I know that right in here there is some management to maybe be done with the bear call spread, just in case.
Oh, sure.
Yeah, just in case if the stock does go up, that green line was the present price. If the stock goes up by more than what he's collected, well, he may have to pay for that. But guess what? By paying for that, he'll stay in the stock, and the stock is up by more than what he paid. It's very cool. What's happened here is we've taken Paul's situation where he's up on his stock, and we've purchased a put that's far out in time,
Mm-hmm.
and done what do you call it? Near in time bear call spreads in order to pay for that put. Very cool. The maximum profit is infinite, meaning that there's no ceiling on this trade anymore. You know, it's not like a covered call trade where you lock in your ceiling, right?
Mm-hmm.
And then the maximum risk is a negative number. Pretty cool. Okay, so he's bulletproof, has no cap, and he does have income. And so anyway, having his put option locking in that $50 all the way to January 11, 2011, he's insuring his McDonald's stock against black swans like, oh gosh, if somebody hits the World Trade Center, you know, with a plane, you know, what if there's a crash in Greece, you know, what if overseas something happens, we have nothing to control it with. Well, having a stop order in place doesn't help you, but having a put option, that's a legal and binding contract. The cost of that put was lower than what he pulls in with one bear call spread, and Mike, could he do it again?
Absolutely. Just like we talked about before, that expires worthless. He still has time of insurance available. That put is several months out in time, so you could do another spread, leave the upside open, and generate a credit against it.
Right. And of course, you know that depending on what the stock does, you might be able to manipulate this put with income method 4, 3, or 9, which we can't get into right now. Okay. So that's income strategies for the buy and holders. Okay. If you happen to be sitting on a stock that's up from where you started, shoot, why not get paid to insure it? This is also something that's covered in the blueprint. Go ahead, Mike.
Can you go back to just the profit and loss chart on that one for me?
Yeah.
Yeah, F had wrote in real quick. I'm not sure if they saw this because the numbers weren't on the left, but F wrote in. Oops, sorry, is this the right one? Oh, no. Where is the loss limited in this example? There's no loss possible. Now, I just replied through the email there, but there's no loss possible. If the stock went to 0, that 50 strike put guarantees an exit of 50, but the cost basis was well below 50. So the stock could go to $1 per share, and there's still guaranteed profit, no matter what happens.
Right. Mike, maybe I should go into a more clear example on how income method number 6 works. Can we do that?
Sure.
Why not? Here's another example.
I wanted to point out something real quick. I know we're not there yet, but before Neil might have to go in a little bit, but before we get to there, Kurt, you're going to talk about the blueprint maybe at the end of the presentation. You're going to talk about what's called the Fusion subscription that we've alluded to a couple times. And
Yes.
Neil wanted to know is that, I've seen several of your webinars, but can I subscribe to Fusion and learn the income methods without buying the blueprint? And the answer is really,
why would you do that?
Yeah, it's kind of, but not really. The lessons, Kurt has put together a long series of lessons for RadioActive Traders Fusion subscribers, but a lot of those lessons are done under the, what's the term I'm looking for, the auspice or the idea that the investor or the reader has already read the blueprint, because the full income method is not discussed in the lessons themselves. There are some things that are missing from the discussion in the lessons for a Fusion subscriber that are in the blueprint.
The blueprint's the foundation, right?
That's exactly right.
And then if you've read the foundation, if you've read the blueprint or the RadioActive Trading Home Study course, which is the blueprint plus videos, okay? If you've done that, then Fusion's going to make all kinds of sense to you. But if you haven't done that, you'll be going in and say, and you'll be pestering, Ernie and Mike and me with questions like, well, what's the SIGA model for income method number 11? Dude, the blueprint will guide you through all that.
And as a follow-up, real quick, Neil also mentioned he liked the part of the Fusion that allows the subscriber to look over the shoulders of someone actually making Mary put trades. When we do those trades sent to the subscriber in real time by text or email? Absolutely.
Yes.
In fact, Fusion subscribers may see as many as 3 adjustments made. As I mentioned, I might do an adjustment on J&J today. I might do one on WY, which both have earnings coming up next week, so I can lower the risk before the earnings event. And we may be adjusting GNC or possibly Brown Shoe as well. So there may be as many as 3 income methods, but there's also a funny thing, Kurt. There may actually be none.
Right. It depends on what the market does.
That's right.
You can't predict that. Okay. So what the market gives us, that's what we respond to. Mike, I've got a poll up there. It says, "What's your single biggest objection to picking up a married put?" And I've had it up there for a while. I'd like to call attention to it. If you haven't had a chance to participate, please do. And it looks pretty one-sided here. Let me give it 3, 2, 1, and fire. Okay, so 7% say no objection. You know what? I've used puts before to protect my stock, and it saved my bacon. Okay, good. 82% say, well, no objection, but I just don't know enough about it. I need to know more. Well, good. That's why I wrote a book about this back more than 10 years ago now. It's been more than 10 years, and the blueprint has enjoyed a number of printings and a number of revisions where we've actually been able to improve the product with the feedback of traders from over 30 countries using the RadioActive Trading method. 11% say it costs so much to have a put, I would make more without it. Well, would you? Would you really? When you have a put option protecting your stock, you just might feel invincible and be invincible. You might be bulletproof against a downturn, but still leave your upside open. I don't know a better way to play. I don't know a better way to play. A lot of folks say, well, I just get out, with cover call. I call the top. I know exactly where that stock would go, and I'd sell a call at that place. I don't know, dude. I don't know. I would have missed out on a 100% gain if I had not used stock and a put option on Amazon in 2002. 100% gain. I would have missed out on a 40% gain on Solar Tech. I would have missed out on another 40% gain on Priceline. Had I sold a covered call, or had I used another method.
Well, here's another trick. We talked earlier about the TLM position, and Kurt, you and I have talked about this. You sort of bring it up for me on several occasions. That trades in 2010, the best trade I had was a 59.8% gain on silver wheat. I wouldn't have been able to realize that much upside by just selling covered calls, of course, or trying to roll the covered calls. That same year, my biggest loss on TLM was 4.5. Had I not been trading the married put positions, that TLM loss, if I was just trading covered calls, for example, my TLM loss would have been closer to about 48 or 49%. Now, if I had a 48 or 49% loss on the TLM position, just rolling calls down as the stock collapsed, and I had a 59.8% gain on silver wheaten, which would have been less anyway if I was trading covered calls. So let's just say 59.8% gain. But if I had a 48% loss and had a 59.8% gain, I'd still be behind.
Yeah, you'd still be behind.
Mm-hmm.
Now, let me just clarify that, because some folks heard you say, you know, let's just round it, 60% gain and 50% loss.
Right.
Some people heard that and said, well, you're up by 10. No. When you have a 50% loss, that means you've got to double your money to get back to where you started.
Mm-hmm.
And double your money is 100% gain. So if you're starting out 50% in the hole, a 60% gain doesn't get you there.
That's right.
Okay, but in fact, you had a 60 or 59.8% gain, and your stock that should have lost you half of your money only lost you 4.5%.
That's right.
That's why we want to use married puts. Okay. All right. Now listen, Mike, I'm going to show the Marvel play, and again, I'm not licensed to use the Marvel universe of characters to recommend radioactive trading, okay? What I'm doing is showing my devotion as a fan. I was a comic book fan as a kid. And anyway, Marvel, it no longer is its own company. It got bought out by Disney. Happy day. But here's the deal, okay? I had 100 shares left over from another profitable trade with Marvel. Now, this is not adjusted numbers. This is exactly what I purchased it at. I purchased 100 shares at $31.71, and it was trading at $35.98 when I had this 100 shares left.
Right, so Kurt's standing on about a $4.20 gain on this position, a little bit more than 10%. You know, we had a couple of people comment on this. We usually do in the previous scenario show, Kurt. Well, that McDonald's example, not everyone's going to have that. That's extreme. That's a little bit uncommon, having a $22 cost basis on a stock and you don't want to lose it. But that's a high gain that was able to be locked in there. But this is more realistic. I mean, I've had positions, some of you may have had maybe naked put positions that you've been trying to roll where you have a gain in the stock. You finally got put the stock as you rolled up. You might have a cost basis of $40, but the stock's trading at $46. That's not unrealistic. You know, so Kurt has a unrealized gain here at 427. And what did we talk about before, Kurt? What's almost harder than managing a loss on a position? Managing a gain.
Managing a gain, yeah, because you're thinking, well, shoot, now what do I do? Do I hold? And then watch the stock go back down and feel like a chump because I should have sold,
right?
Or do I sell now and feel like a chump because it keeps going up? Gosh. Okay. Well, here's an alternative. So my net profit, if I want to sell here, I'll get $4.27 profit from this 100 shares, right?
That's right.
Here's what I did instead. The January 2010 $40 put, now remember this is June of 2009, okay? The January 2010 $40 put options were $6.50. Remember, I had cheap shares left over from another profitable trade, okay? And so the 5 lines go like this. I've got $31.71 cost basis on the stock. I'm buying this $40 put for $6.50. My total invested then is $38.21. But I'm guaranteed to be able to get out at 40, so my amount at risk is a negative $1.79.
Right.
Okay. Now, what a lot of folks think I just did, because they're not used to put options and used to married puts. Okay. What a lot of people think I just did was trade a certain gain of 427 for only $1.79, but that's not the case.
Right.
if I wanted to unwind this the next minute, Mike, could I conceivably sell this $40 put for $6.40?
Absolutely. When I open a married put, or anytime I buy that put from that position, on a position, if I'm just opening a new married put trade or doing it in this case, all I'm risking when I open the first position is the bid-ask spread of the put. I could turn around and liquidate it for only a 0.1 or 0.2% gain, and sometimes, if the stock moves up, 30 or 40 cents in the first 10 minutes after I open the trade, I could go ahead and liquidate it for a profit of 0.1%.
Yeah. Yeah, absolutely. So the point is here that no, I haven't traded my 427 from the previous page. I haven't traded it for $1.79. I've just made it so that for the next 6 months, if I want to hold it for the next 6 months and the stock tanks, well, I'm going to still make $1.79 at least.
Mm-hmm.
Okay? And the stock did not tank. All right, so Mike, here's what the married put looked like using the power option software. It looks like this, where I've got a negative 4.7% risk. Right?
Yes.
But still have an unlimited upside.
That's right.
The stock can keep growing. All right, now, here's the deal. I decided that I wanted to also pick up some more money, and this was an earlier deal. So instead of 11 income methods, it just talks about 9. Okay.
Mm-hmm.
I'm going to show income method number 6, selling a bear call spread for a credit. Now, I sold to open an August $40 call for $1.78 and simultaneously bought to open an August $45 call for 28 cents. So that generates $1.50. Pretty cool?
Okay, with it so far.
Okay, so I've made $1.50. Now, normally a bear call spread risks money. How come?
Well, you generated $1.50 up front, and in this case, we're looking at a 5-point spread. So if the stock gaps up against us on a standard leverage spread position, we run the risk of losing 5 points, but we keep the $1.50. So we're looking to make $1.50, and at the same time risking $3.50.
Right. I don't like that. I mean, I don't like the idea of, hey, if you're right, you get $1.50. If you're wrong, you lose $3.50.
Mm-hmm.
I don't like that. But you know what? It doesn't work that way because of the context in which I'm doing this. A bear call spread, the risk of a bear call spread comes from the fact that that stock might go up and you don't have it. And if you don't have it, you've got to buy it.
That's
so
right.
I'd have to exercise my $45 call to buy stock at 45 and deliver it at 40. And that's the reason for losing the $5 minus the $1.50 I took in. Okay, so I'd lose $3.50. So here's the deal, Mike. What if I have the stock on hand? Do I have to employ this $45 call option? Do I have to use it? No.
Not at all.
The context of owning the stock, look at this. This is a nice flat line down here. Now, we've got a lot of doctors that do radioactive trading, a lot of dentists too. But we've got a lot of doctors do radioactive trading. You know what they don't like to see? Flat lines.
Flat lines, right.
All right, now looky here. We've got negative $1.79 at risk, right? Negative 4.7. Watch what happens when I overlay the bear call spread. See, we got a little heartbeat. Boom. We collected $50, making our maximum risk what? Negative 327. Our maximum risk is negative 8.9%. Isn't that something? Because I have the stock on hand, even if I have to deliver the stock, I don't get hurt. And that $45 call, well, I've been paid to own it. Stock wants to keep going up, be my guest. I'm in the money. I own a $45 call option, and I've been paid to own it. Kind of cool. So let's just recap a second, okay? The stock was trading at $35.98. The cost basis was $31.71. So if I sold right then, it would have been $4.27 profit, right?
Yes.
Okay. But what I did instead was I held onto the stock with a guaranteed $3.27 for 6 months. The guaranteed $3.27 comes from part of my upside is guaranteed by buying a put that's slightly in the money. And another part of the guarantee comes from picking up $1.50 that I never have to pay back.
Right.
Isn't that something? So instead of $4.27 now, I'll take $3.27 for that I'm guaranteed for the next 6 months, but still be able to play it for further upside. Guess what happened? Stock did go up. I sold that bear call spread for $1.50 credit, right?
Mm-hmm.
But that $1.50 credit came with no risk because of the context of the Mary put. Now, the stock dipped down a little bit, and I closed the $40 call only for 45 cents. So I still have $1.05 in my pocket, right?
That's correct, Kurt. Yes.
I'm also sitting on a $45 call option that, well, I've been paid to own. I've been paid to own it because it was part of that spread. And my thinking was, hey, I think Marvel is going to shoot up, and when it does, if it does, I'm going to make money on the stock, but I'm going to also make money on this long call.
Right.
Well, that's not what happened. Alas, okay, it did not happen. The $45 call did expire worthless, although I've been able to do what I just mentioned. I've been able to do that before, okay? I think it was on GameStop, where GameStop goes up, and then my calls also gain. The calls, the stock traded flat, but I made 13% with it.
Okay.
Kind of interesting. It went down, went up, went down, went up. When it went down, I closed short calls. When it went up, I cashed in long calls. Kind of cool. Anyway, the long call expired worthless on the third Friday in August, but the setup is what's important. I'm set up in a place where I'm not risking anything and yet have upside.
Mm-hmm.
The end of the month, August 31st, Disney says, we're going to buy Marvel for $4.4 billion. My stock goes up to nearly $50 a share. Now remember, for both the stock and the put, the cost had been $38.21, right?
That's right, Kurt.
Okay, so I made $10.20 for holding the stock. I made $1.05 by doing the bear call spread. And you know what? I was even able to sell the put. Not for much, but I was able to sell the put. So instead of picking up $4.27 for selling, I bulletproofed myself and used the radioactive profit machine to not have any risk and end up with a 30.2% gain in 2 months. So very cool. Who else wants to be bulletproof? Mike, I'm going to throw up one of our last polls, okay? I'm going to ask folks, hey, what did you get out of today's lesson? You know, what did you appreciate? And how are we doing on time?
We're at 10, 15 minutes past, yeah.
We better get to that offer here really soon. Are there any questions that we might ought to handle for the whole audience? I know that you've been typing furiously.
Yeah, I think we covered most of them. We had some clarification we did with F there, of course, when we showed that, and I related the MCD cost basis to one of our other customers who asked about that. What was the position done there? Corrado wanted us to know that, he had mentioned, go ahead and pick up the blueprint, guys. You won't regret it. I procrastinated for a year or so to get it while I was losing money, but now he's actually trading radioactively.
Yay, Corrado. I've seen his name on a number of webinar attendee lists, right? Mm-hmm. And so I'm very glad that you picked that up there, Corrado. Very good.
Another question asked, we are recording this presentation, Kurt, but are we going to post it this afternoon?
I'd be pleased to post it if you would.
Yeah, I just have to verify that, so we'll replace it there, and you can access the webinars anytime. Just go to RadioActiveTrading.com and click on the free webinars tab at the top of the screen.
Cool. Our winner is, I like seeing how to leave the upside open. If you leave the upside open, you can increase returns. Absolutely. I was looking at a cozy little, I don't know, 10, 12% gain on Marvel and turned it into a 30% gain. Mm-hmm. Happy day. 43%, we got a tie here. 43% said, I see how using a put can keep you out of trouble. Yes. And another 43% said, I need to know more about those income methods before trying them. Thank God you're saying that, because a lot of folks will come to a radioactive trading event, say, oh, okay, I see what you're doing there, and ignore the fact that we've been doing this with real money for over 10 years, making improvements to the process, learning along the way, mm-hmm. getting feedback from a community of users, and improving what we're doing all the time. And they'll come to an hour webinar and say, wow, okay, so I'm going to buy a put and I'm going to sell a call. Or I'm going to buy a put and I guess I'll do a spread trade along with it. What? There's a lot more to this than you think. Okay? All right. Let's see. Go ahead and hide that. Final poll. What might you expect to pay for a seminar information product that takes you through 11 of these kinds of adjustments? We showed income method 3, income method number 9, income method number 1, and income method number 6 today. There's 11 total. What would you expect to pay for something like that? And while you're answering that, folks, I'm going to go ahead and pull up the, well, it looks like I added to this with Steve's Starbucks position. Steve's real happy, by the way, Mike. He was able to get paid to insure his stock.
Mm-hmm.
That's kind of cool. Okay, I'm trying to get out. All right, there we go. Now I know what I'm doing. Are you seeing my screen, or are we still on the poll?
I'm on the poll here. What might you expect to pay for seminar information, so forth? Mm-hmm. That's what's showing right now.
Okay, good. This is our last poll. Let me go ahead and leave that up for another 3 seconds, 2 seconds, 1 second. And what? You know what? Maybe I better not close. Some other folks came in and voted real quick. Okay, I'm going to for real close. Here we go. Okay. Do you see that, Mike? Yes. Okay, so 78%. We got a classic 80-20 split here.
Indeed, we do.
78% say, you know what? Probably about $350, and then 22% said at least $1,000. At least $1,000. Let me go ahead and hide, and I'll tell you exactly what it is. It happens to be $350 for the blueprint. It shows all 11 income methods. Okay. Now we've got a premium product that sells for a little more. It's the home study kit. It includes the blueprint, but then it also goes through all of the 11 income methods by way of video. So if you feel that you learn that way better, if you feel that you learn in a setting like what we're doing here and now, where Mike and I are discussing back and forth, and we're putting up examples, and we're animating it, you know, and there's charts and graphs that, you know, if that's how you learn better, then the home study kit is your way to go. And then the blueprint is still included for easy reference. You know, you just want to say, gosh, all I want to do is look at an adjustment on income method number 4 and how I bulletproof this, and then you would, you know, be able to pull that out of the blueprint in seconds. Well, if you feel like you don't need all that, you don't need the multimedia stuff, and you just want to read, well, then the blueprint, we've been selling it now for, oh gosh, for $339, and then there's $11 shipping, so that's the $350. It happens to be $41 shipping if you're outside of North America. If you're outside of the United States and Canada, it's $41 shipping. Okay. Cool. Mike, do you think we covered all the good stuff?
I think we're good. We'll have another presentation next Tuesday at 12 noon Eastern Time. Remember, folks, we have expiration coming up in a couple days. Tomorrow, what Kurt likes to call payday. The markets will be closed on Monday, of course, and on the national holiday. But we'll be back on Tuesday at 12 noon Eastern Time with a new presentation, a different presentation, I should say, and then it on Thursday as well. So we hope to see you guys soon. We hope everyone has a great expiration.
Yes, very, very cool. Yeah, I'm going to be happy with it tomorrow.
All right.
Okay, Mike, we'll see you out there. And folks, pick up the Blueprint and Home Study Kit. I probably should mention that when we talk about bulletproofing, bulletproofing is taking a position that has a small amount of risk and then turning it into a position that has zero risk. Well, that's how we want to begin our relationship with you. And the Blueprint and the Home Study Kit both come with 100% money-back guarantee. So we really take the risk. I mean, as far as taking our time and effort, putting this together, shipping it out to you, and if you don't like it, hey, we'll take it back. We process very few returns, very few returns. And obviously, Corrado is happy with his purchase. Was that recent there, Mike? Because I've seen him